How to become your own bank. Some people call it infinite banking, but I have to warn you, this is gonna piss off every financial advisor that watches this, because I am going to walk over everything that you guys do, and I'm going to prove that what you guys do doesn't work and is inferior, and how much you do not know about finance and money. So what's up, guys? This is Ben Ober. Your not financial advice for today is how to become your own bank, or infinite banking, some people call it that. And we're not gonna use these inferior index universal life policies or these low-grade financial products that advisors sell you. We're gonna use what very few people know about and what is institutional grade, and I'm gonna tell you how you can get access to it all in this video. And by the way, I'm not an advisor. I don't get paid to teach this shit to you. I just want to expose you to the real truth, and I'm actually gonna show you advisors in a little bit arguing with me, saying that what I do doesn't actually exist. It does. I've been making a lot of money with it, and I'm gonna tell you all of the steps that you can follow to do it, and the 4 specific steps that I use to become my own bank, lend capital myself, get 2 returns simultaneously, go into hard assets that cash flow, repeat the process, pay low taxes, and keep doing it over and over and over. All right, guys, welcome to my channel. If you're brand new, if that wasn't subscription worthy, I don't know what is. Make sure to subscribe. We're dropping bombs about teaching you guys how to become your own bank, escape the modern financial system, and build wealth like an institutional grade investor. And I don't gatekeep. I tell you exactly what I'm doing, and I show you that we're doing it. First of all, what is infinite banking? It's this concept where you're basically lending capital to yourself with a tool that you acquire so that you can bank against your own assets and repeat the process. If that sounds confusing, I will explain in just a minute here. First of all, we got to debunk what the financial advice is that you have been told. A lot of advisors sell what's called an IUL, or an index universal life policy, so that you can infinitely bank. There's a couple problems with this. One, IULs have a hidden insurance cost that you don't get to know what it is. So when you're investing in an IUL, which is basically something you could think of like a savings account, but has an insurance component attached to it that you must spend money on, okay? The problem is that insurance cost is hidden to you. The second problem is that IULs tend to only get 4 to 6% in annual returns, which is pretty low. The third problem with IULs to bank infinitely is that you have to borrow directly from them, and it stops the growth of your cash in there. I don't do that. I let my cash keep growing and I borrow against it. So we're gonna break this down. The next thing that you need to know is that how to do infinite banking effectively is with what is called an institutional grade, high early cash value, dividend paying whole life policy, or for short, a HECV life policy. You do not want to use Primerica or Prime America, whatever it's called, or an inferior grade company. You want to work with a company that has an A+ grade credit ranking, in other words, higher or as high as the United States government or the US Treasury. Now, the next thing that you must know is that this concept and these companies are older than Bank of America, Wells Fargo, and Chase. And the real truth is that you should be making 9 to 11, sometimes 12% per year on your money insured before you do anything else. Let's simplify it. Step 1 is you want to get a HECV life policy. I'm going to tell you who I use, what I do, how I work with it, how you can get access to that later in this video. But let's just explain some math here. You can get a high yield savings account growing at 4, 5, 6%. An average savings account grows at less than 0.5%. What I get is 2 things. I have what's called a guaranteed return, which is 2 to 4% minus 4%. You got to go through an underwriting process and see what you get. But let's just use my example. I get 4%. And then I have what's called a non-guaranteed dividend. This dividend comes to me tax-free. The company I use has been paying a dividend no less than 6% for the past 50 years. So I've got 4% here, and then I have a 6% dividend over here. Combined, what is that? It's 10%. Now this year, my dividend is up to 6.4%. So I'm actually making 10.4% on my money. I don't buy tons of insurance. My insurance cost is literally $37 per month. And every single dime past that I put into this policy is in cash value. You have 4% growth, you have 6% growth. Again, mine's 6.4. I'm making 10.4%. I set this policy up so all of that growth, and when the dividend is paid back to me, it goes back into the cash value. So let's say I just start with $10,000 of cash value. I'm gonna keep this in layman's terms, and I'm making 10%. That means I'm gonna make $1,000 in the first year. Now I've got $11,000 of cash value that's growing for me. And then that's gonna be $11,100. And then it's gonna be $12,100 the next year. And that's gonna continue growing and compounding. Like Einstein said, compound interest, okay? And I'm gonna keep stacking that up. That That keeps growing at 10% plus for me. And then I get a line of credit against it. So step 1, you get this policy. Step 2, you get a line of credit against it. This is where IULs become inferior. You have an IUL growing at 6%, and then what you end up getting is a policy loan, which stops the growth of this. You borrow against it, and then you lose the leverage. So what I do is I keep this growing, and I get a line of credit against it at 4 to 6%, okay? This is growing at 10.4%. I'm borrowing at 4, 5, 6%. So I'm already making money. The third step is I go into hard asset, that cash flow, allow me to get all my money out and repeat the process, so I am generating an infinite return. And I'm gonna dive deeper to that in a second, but that is where the term infinite banking or becoming your own bank comes into play. But let me know in the comments real quick, have you ever done infinite banking? Do you own an insurance policy? If so, what type? I am happy to argue in the comments because I can base all of this on literal fact. And as a matter of fact, the reason why so many advisors argue with me about this, and bear in mind guys, I own a marketing company that works with hundreds of advisors. None of them do this. None of them know about it. I have met one of 30 individuals in the entire United States that is actually allowed to provide these types of institutional grade products to not institutions, to not banks, but to individuals just like you and me every single day, and I work directly with them. And I'll talk a little bit more about that in a second here. So step 1, you got to get that policy. Step 2, you get that line of credit. We help you just get both simultaneously so you don't have to go about it and do it yourself. Then the third thing is you need to go into assets, that cash flow, so you can use that cash flow to pay the line of credit back. So let's just make a round even number, for example. You have $10,000 of cash value. You get a $10,000 line of credit, okay? And your line of credit is typically going to be 90 to 100% LTV, loan to value. So if you've got $10,000 of cash value here, you can get a $9,000 to $10,000 line of credit over here. And every year that this goes up, what I want you to do, and again, this is my not financial advice, is you level up the line of credit. This is $11,000 line of credit. This is $12,000 line of credit, and that's going to increase your leverage. When inflation is 2, 3, 4, or 7, 8% like it's historically been in the last couple of years, and this is growing at 10, 11%, and you're borrowing at 4, you're hedging inflation and still making money, right? And again, these are fully insured beyond the FDIC limit of $250,000. These big insurance carriers have to keep as a balance equivalent to the cash value or death benefit. So if they ever went insolvent or just decided, hey, we're not going to be an insurance carrier anymore, we're going to open a McDonald's franchise or become a car dealership or something, they would have to pay that out to you. So it's better than FDIC insured, all right? It is literally what the banks use. That's what I do here, okay? So we've got all that. Now we need to go into assets, that cash flow. I prefer real estate and I prefer oil. I'm not talking about oil stocks. I'm not talking about real estate stocks or ETFs or anything like that. I am talking about the hard asset itself. But if you're like me, I want to do things with my life, so I don't want to actively manage real estate. So I go into a couple really reliable funds that I'm actually partnered with, and then I go into oil and energy deals where I'm working with a landman like that show, an operator out of Oklahoma or Texas, for example, and I'm given capital and they're spitting out cash flow for me as they sell barrels of oil, as they sell natural gas, and as that product gets refined. So I get cash flow every single month, and then they take all those oil wells that they own interest in, and after 3 to 5 years, they sell those oil wells, and that's a big payday. So I use the cash flow of that real estate or that oil to pay the line of credit back, and then anything above that I keep. That's where the infinite return comes in, and I pocket that. And I can do that with multifamily, I can do that with single family, I can do that with oil and energy wells. So that's your third step. The fourth step is to repeat. But there's a nuance to this repetition. Understand that I just said real estate and oil. Now, why would that be? Let me know in the comments if you understand. Why would I specifically go into real estate or oil? I'm curious. Put this on pause, take time to comment, and then go ahead and continue playing, and I will answer that. But I want to know right now what you think. Why do I go into real estate or oil? So the answer why I go into real estate or oil with infinite banking is because real estate and oil from an IRS tax perspective allow me to have a lot of write-off. Oil I invest in because the capital that you invest has what's called an intangible drilling cost attached to it. It allows me to write off as high as 80% of the investment capital. So I'm already winning there. Then there's what's called tangible drilling costs. This pertains to the cash flow. Over the next 7 years as I cash flow, tangible drilling costs can be depreciated over 7 years. So I'm able to take depreciation every single year. In other words, lower my taxable income, lower my tax basis on all the cash flow that I'm getting. And the third thing with oil is what's called a depletion allowance, which right off the bat, for every dollar in cash flow that oil well produces me, I'm only having a tax basis of 85 cents on the dollar. Then I get the tangible drilling costs, which are depreciation against that. I pay very little taxes. Now I can go on because there's a lot of other stuff like 1031s in oil, but let's hop over to real estate. Much like oil, real estate offers me depreciation, it offers me passive income tax bracket, it offers me a lot of tax incentives, and much like oil, I'm able to use that cash flow to pay my line of credit back as quickly as possible and repeat the process. And the reason I love doing this, another reason, is because I don't have to wait to like sell the oil deal or sell the real estate to repeat the process, because the cash flow is coming in at such a rampant pace that I'm able to quickly pay that line of credit back and go get another oil deal, go get another real estate deal before I've even sold or capitalized completely on the initial one. Now, if you guys want to learn more about this, this is what the Capitalist Network is about. I've included a link in the description. I connect you with all of my oil operators, all my real estate guys, all my fund managers, my precious metals dealers, my exotic car people. I get you in front of all of them so you can learn how to do all of this yourself. You understand economics. You're able to actually partner with us, go into our deals, and get first-hand access to the type of deals that are not publicly open to the market or available. We expose you to all of that inside the Capitalist Network. I've included a link in the description. Again, if you're brand new, make sure to subscribe because I'm dropping videos like this every single week. Smash that like and I'll see you in the next video.